No matter which way you look at it, the stock market overall is doing terribly at this moment. Every major index, including the FTSE 100, the S&P 500, the Nasdaq, and even the FTSE 250 is down month on end. So how has this affected my personal trading 212 portfolio? In this video, I will show all. So here is my trading 212 portfolio, and as you can see, my current portfolio balance is £11,560, and you can see that my overall return is the lowest it's ever been on these updates at minus £694.57. So that is a 5.67% loss. Now, I know as an investor this might sting, but realistically overall we shouldn't as long-term investors care about small market fluctuations. But that being said, if we're invested into individual companies like I am in this portfolio by very small amounts, we may be wondering what the individual performances of these companies are, and in this video I'm going to show everything that I can. So I am down nearly £700 even though I've deposited around £1,400 this month. So as you can see, before depositing I was down around £300, and then recently you can see the big drop off going all the way down to nearly £700 in the negative. So let's go through how many free shares I've got so that we can mentally disregard that amount, and also for transparency's sake I would love to show you how many free shares I get. So in total I have received 36 free shares with a value of £633. I'm very grateful for everyone that has done that, and if you would like to sign up to Trading 212, use the link in the description down below and we will both get a free share. So first up, I have 0.1 shares in Walt Disney, and that currently has a value of £8.57, and as you can see that is down by £2.01, and that is a 19% loss. Now over the past month, surprisingly, Walt Disney has stayed quite flat with an overall gain of around 0.04%, so nothing to write home about. But as you can see, it was on quite the incline until about the 17th of October. Around about this time, the bond yields have spiked, causing a massive disruption within the stock market. Essentially, with bond yields so high, most people don't think that the stock market has a good premium over guaranteed rates. For example, some bonds are giving 6%. People are losing more than 20% in the stock market, and essentially during these high interest environments, people would rather get guaranteed amounts rather than try their luck with a potential gain. However, as a long-term investor, I think these are one of the best times to be investing, because I do think that as the price keeps going down, you're buying into better value stocks, and when the next bull market comes around, in my opinion, I do think that you're going to be making a lot more, and you'll be very grateful that you put your money into stocks instead of putting it into bonds, which of course after the interest rates decrease, the bond yields will also go down accordingly. So in terms of income statement, you can see that the revenue of Walt Disney has gone up and their net income has also gone up. If we have a look at their balance sheet at a glance, you can see that it's remained quite steady over the past few years. However, that being said, Disney is in trouble in terms of its decisions that it's been making recently that haven't boded well for both the public and its shareholders. So next I have 35 shares in Vodafone, and that is worth £26.56. That is down by £5.44, and that is a loss of 17%. So over the past month you can see that Vodafone is down by a quite big 7%, which is actually really high. As far as I know, they are merging with Three to make this ultimate mobile network, and I don't know how well that actually will turn out in terms of how happy customers are, because that could lead to price hikes as the two companies join together, and essentially what they can do is increase the amount of their mobile phone bills, essentially making them less of a popular option to go for in terms of your mobile phone contract. So I don't really know how the business is going to be going in the future, but we can look at what it's doing right now. You can see that currently the dividend yield is a massive 10%. So I think going forward that could be cut anytime soon, because a 10% dividend yield really does indicate a lot of the times that the company isn't really in a financial situation to keep paying out such a high amount of dividend. But then again, the stock price has gone down a lot, and that would affect the dividend yield, so I'm not too sure about that. We can see by the income statements, the net income is up, the revenue has stayed quite similar. But then again, companies like this, the way they report their income statements is sometimes quite misleading, so you can't really at a glance just look at income statements or even balance sheets to see how well a company is going to be doing in the future. So from a quick look at their balance sheets, you can see that they have been quite steady since 2020, which isn't necessarily a good thing, and it could indicate that how they are measuring their assets is not exactly what they have liquid. So just by looking at this balance sheet, you can't really see where Vodafone is going to be going in the near future. So next I have 0.8 shares in the Vanguard Germany all cap, and that is down by £2.20, so that's 11%. Over the past month it's down by a big 5%. For a big index like this, 5% is a very, very high amount. You can see that over the past year again, they're not doing great, with Germany having declared official recession a few months ago. The economy doesn't look that great for Germany, let alone any other European country or even the United States of America right at this point in time. So next is my biggest holding, which is in the Vanguard FTSE 250. So currently I have 252 shares in this, and it is worth at the moment £6,671.13. And as you can see, I am down personally by 7.97%, and in the past month it has gone down by a staggering 8.53%. So as you can see, this is one of my biggest losses to date at minus £578. I, however, am not in the slightest worried, because as I get my money, however frequently I do that, I'm going to be putting it into either this or the S&P 500, and I do think at these prices I'm going to be stocking up, and come the next bull market I really do think it's going to pay off massively. Next I have 0.17 shares in Tesla, and that is still up by 96 pence, so that's a 3% gain. As you can see, over the past month, a huge tank, going minus 19%. However, as you can see, I'm still up because I bought this a few months ago and Tesla was on a huge upwards trajectory. You can see that they don't pay a dividend yield, and from the income statement you can see revenue is growing up near exponentially, net income is up. From the balance sheets, the total assets are just increasing and liabilities are increasing. Again, I do think that Tesla, even though it's highly speculative, is going to be a company that is going to keep growing for at least the foreseeable future. So I'm not too worried about Tesla, but then again, I don't even have one full share in that. So next I have 0.2 shares in Starbucks, and that is worth £16.17, and that is down by £1 whole pound, so that is a 5.82% loss. So over the past month you can see that Starbucks has actually been doing quite well until about, again, the 18th of October, and overall they are only down by 1%. However, in my portfolio they are down by 5.82%. Again, not a huge amount in Starbucks, but it is still beneficial and fun to know about how these companies are investing in case you have a bit more of Starbucks or any of these other companies inside your portfolio. As you can see from the income statement, revenue has gone up, net income is similar to what it was last year. Companies like Starbucks are often not very much affected by these recession type periods, as people are going to still, regardless of how bad they're feeling and how bad their wallets are, they're still going to want coffee and comfort food. So again, Starbucks hasn't been too affected by this. You can see from their balance sheet that the amount of liabilities they have exceeds the assets, but again, that isn't always an indicator that a company is going to fail. Usually you still have to look at the cash flow. As you can see from the cash flow, it does seem like their financing and investing costs do exceed their operating turnover, but then again, I am no financial expert, and I'd probably have to sit down and look deeper in their analytics to see if they're a viable company in the future. They do pay a current dividend yield of 2.4%, which isn't too bad at all. So next I have 29.7 shares in RollsRoyce, and that is worth currently £59.13 in my portfolio. That is also a return of 54%, which I think is very, very good. However, over the past month, RollsRoyce has tanked quite a bit, down by 11.53%. Again, FTSE 100 and FTSE 250 companies are doing incredibly bad. This has a lot to do with the fact that the interest rates are so high in the UK, and given the fact that core inflation isn't really going down, with CPI the same figure, 6.7% as last month, people are expecting the Bank of England base rate to go up yet again, meaning that there will be a lot more trouble for these businesses. Any sort of business at this point in time has to be making a lot more profit, because there are no longer times of no interest or very low interest, and many sacrifices have to be made to business models in order to accommodate this much higher interest rate environment. So currently RollsRoyce does not pay a dividend yield, and as you can see from the revenue has increased, net income has decreased. Balance sheet again looks like a huge amount of liabilities, and from the cash flow we can see that a lot of this has gone into financing, with operating and investing revenue seemingly not actually covering their financial costs. So next I have 1.6 shares in PayPal, and that is down by 11.25% in my portfolio, and that is a negative £9.01 loss, currently worth £71.06. As you can see, PayPal also hasn't had the greatest month, with the 19th of October seeing a big decrease. As you can see, until the 19th of October, it was still up by 0.25%, and since then it is down by 12% overall from the last month. PayPal does not currently pay a dividend yield, and as you can see from the revenue has increased, net income has decreased a little bit, and from the balance sheet you can see that the total liabilities are increasing, and from cash flow you can see that their operating revenue could possibly cover their investing and financing costs. Again, if you do want to invest into a company like this, I recommend that you look deeper into the financials so that you are given the best information for your investing decisions. So next I have 2.3 shares in Orange, and that is down in my portfolio by 2.75%, so not too bad at all. Currently it has a value of £21.95, and it is down by 62 pence in my portfolio. Over the past month, Orange is down by 3.83%. So not too bad all things considered. They currently pay a large dividend yield of 6.46%, and as you can see from the income statement, revenue seems very high. Income also increased from last year, but again you have to look at things like their balance sheets. Again, as you can see, very similar to last year, but when we look at their cash flow, we can see that their costs in investing and financing does seem to somewhat exceed the amount they're getting from their operating ventures. So next I have 0.09 shares in Nvidia, and in my portfolio they are up by a massive 189%. So that is a gain of £20.13. Overall, however, Nvidia since around the 12th of October has gone down quite a bit, and they are down 2% from last month. They do pay a very small dividend yield of 0.04%, which is pretty much peanuts. But you can see from the income statement that their revenue has been increasing since 2020, this year being slightly less than the previous year. However, from the balance sheet you can see that they have a lot of assets that can cover their liabilities, and currently a lot of money is going into financing. And as we know by now, Nvidia is one of the front runners for the whole AI technology boom. We think that most of the chips that are going to be processing these AI things are going to be made by Nvidia. However, we could be wrong, but as the stock market is forward looking, if a lot of people anticipate that Nvidia is going to be making a lot of money, then they're going to be investing right now. So next I have 0.25 shares in Nike, and that's down by 1.33% in my portfolio, down by 29 pence. So over the past month, Nike has actually been doing quite well, and it is up by 9%. They do pay a dividend yield of 1.32%, which is quite low. And as you can see from the income statement, the revenue has increased since 2020 quite nicely there. And from a cash flow perspective, a lot of that is spent on financing, which could be detrimental for its future. So next I have 0.49 shares in National Grid worth £4.77. That is down currently in my portfolio by 3.83%. That is a loss of 19 pence. And as you can see over the past month, they are down by nearly 7%. They do pay a good dividend yield of 5.7%. As you can see, revenue has increased quite a lot since last year, and their net income has too. Balance sheets look also good because their liabilities have decreased. But when we look at cash flow, they spent a lot of money investing last year, and this year they're spending still a lot on their financing costs. Next I have 0.3 shares in Mercedes-Benz worth £20.80, down by £2.06, so that's a loss in my portfolio of 9%. Over the past month they are down by 9.27%, so not doing too well there. They do pay a great dividend yield of 8.2%, and as you can see from the revenue, it has been increasing. And as far as the balance sheets go, they look quite similar to the previous years, with them spending a lot of money on investing and financing, which could potentially pay off in the future. Next I have 149 shares in Lloyds Banking Group, and they're down in my portfolio by a quite large 16.2%. In my portfolio I am down by £12.02. So over the past month they are down by 6.84%. They do pay a decent dividend yield of 6.06%, and as you can see from the income statements, net income is down quite a lot. Total liabilities are also very high, but again, this is a finance company dealing with money, so it is not too uncommon to see these companies with a high amount of liabilities. In terms of cash flow, we can see that operating revenue is very high compared to the financing and investing, so then again, I do think at a glance it is not too much of a worry at all. So next is my second biggest holding, and this is the GSPX iShares S&P 500. As you can see, I have 520 shares in this, and it is down by 3%, which is not too bad, but that is a loss of £115. Now, over the past month, the S&P 500 has not been doing too well, down by 5% in this index. So next I have 6 shares in Royal Mail, and they are up in my portfolio by 12%, so that is a £1.68 gain. Over the past month, they've actually thrown away the gains they had last month, down by 9.52% overall. They don't pay a dividend yield, but if we look at their income statement, we can see that their net income is down. Balance sheets looking like assets are reducing, and from a cash flow perspective, a lot of money is being spent on investing and financing. As you can see, 2021 and 2022 were quite similar in that case too. So next I have 2 shares in H&M, and that is worth £23.91 in my portfolio, up by 7.85%. So that is a gain of £1.74. Overall, throughout the last month, they are down by 2.76%. They do pay a decent dividend yield currently at 4.25%. And from the income statements, you can see revenue has been increasing slightly. Balance sheets looking like they're taking on more liabilities. And from a cash flow perspective, you can see the financing costs have increased since 2020. So next I have GSK, and they are up 10% in my portfolio, giving me a yield of 40p, and that currently values in my portfolio at £4.37. You can see over the last month they are down by 4.63%, and they were doing quite well at the beginning of October, but not so well right now. Dividend yield 3.8%, quite decent, and as you can see from the income statement, their revenue and income has been increasing. Balance sheets look very similar to previous years with the ratio of assets versus liabilities. From a cash flow perspective, you can see that a lot of it has gone into investing. So next I have 2 shares in Direct Line Insurance, and they are down by 17% in my portfolio, giving me a loss of 69p. Nice. So they are down from the previous month by around 7%. They currently do pay a decent dividend yield of 4.64%. And in terms of income statement, they are not doing too well at all, with them posting a loss, with their net income being a whole lot less than the previous year. From balance sheet again, we can see the amount of assets are also coming down, probably due to them selling that off. And from cash flow, you can see that they could be in quite a bit of trouble from their financing perspective, as they are spending a lot more on that. Next, I have Deutsche Lufthansa, and they are down by a huge 26%. And that is a loss of £15.31. So over the past month, again, a huge loss of 18%. They don't pay a current dividend yield. So with aviation literally taking off and airports being as busy as ever, as we've seen with Luton Airport, and even myself taking a few flights this month, Deutsche Lufthansa hasn't been doing too well. They don't currently pay a dividend yield, but we can see from the revenue they have been increasing dramatically, and we can see that they have a high amount of liabilities from the balance sheets. This is quite normal for the aviation industry, and from a cash flow perspective, we can see the operating revenue is very, very high, and that seems to be covering investing and financing for the time being. So next I have 0.67 shares in Delivery Hero, and they are down by a massive 36%, a loss of £8.41. Currently they are worth £14.38 in my portfolio, and as you can see over the past month, they've tanked by 23.51%. They don't pay a dividend yield, and as you can see, revenue has gone up, but their net income has decreased quite dramatically, and this is in the billions, by the way. So in terms of balance sheets, we can see the liabilities are increasing, and if we look at this from a cash flow perspective, they are losing money operating, and they are kind of recuperating a bit from their financing. So next I have 1 share in Carnival, and that is up by 16% in my portfolio. So that is a gain of £1.14. So over the past month, they have been doing terribly, down by 25%. They pay a good dividend yield of 4.6%. And as we can see from the income statement, revenue has increased, net income has decreased. However, from balance sheets, their liabilities are increasing. And from cash flow, we can see a lot of money is being spent on investing. They're operating at a loss too, and some gains from their financing. So next I have 18 shares in BP. They are up by 2% in my portfolio. That is a gain of £2.04. Currently my shares are worth £100. Over the past month they are up by 4%. This is not surprising given the fact that oil prices yet again are increasing, causing the CPI to actually stay steady. In fact, food inflation is down from the past few months, but because of the rising cost of fuel, that is increasing the overall core inflation. Going forward, I do think that BP is going to be making a lot more money, as they have historically been making a killing of this recession. They do, however, pay a dividend yield of 3.89%. And as you can see, revenue has increased near exponentially. From the balance sheets, everything looks fine. High amount of liabilities, but they are also holding a lot of cash. Let's look at the cash flow. We can see from the cash flow that the operating income is very high and a lot of their costs are going into investing and their financing costs. So next I have 0.12 shares in BMW and they are down by 5.48% in my portfolio. Currently worth £10, I am down by 58 pence. So over the past month, they have gone down by 6.64%. They do pay a great dividend yield of 9.09%. And as you can see from the income statement, revenue has been increasing very well as their income. Looking at their balance sheets, looks like their liabilities have decreased a bit and their assets are going up, which is pretty good to see at a glance. From a cash flow perspective, we can see a lot of it is spent on financing, which is a lot more than what they were spending last year, especially given the high interest environment. A lot of people don't want to invest now because of the implications of the borrowing costs that these companies have to go through, and that's kind of what devalues the price of their stock at the moment. Next, I have 1.3 shares in Aston Martin, up by 51% in my portfolio, currently worth only £3.01, up by £1.02 since starting investing. As you can see, over the last month, they are down by a massive 28%, which is absolutely huge, especially because Aston Martin loves to go down quite a lot. As you can see a lot since 2018, and even before that, they actually tanked by 50%. So they don't pay a dividend yield, and as you can see right now, their revenue has increased, but their net income has decreased significantly. From the balance sheet, you can also see liabilities are increasing. From a cash flow perspective, you can see that a lot of the money is spent on investing, and they are making some money back from operating and also their previous finances. So next I have 0.02 shares in Asml and they are down 17% in my portfolio, currently worth £10.05, down overall £2.08. Over the past month, they haven't been doing too badly, down by 1.65%. They do pay a very small dividend yield of 1.08%. As you can see from their income statement, revenue has increased, net income looks like it's decreased a little bit. Balance sheets look like they're increasing the amount of assets as well as their liabilities. From a cash flow perspective, we can see a lot is being spent on their financing, but operating does seem to be covering some of that anyway. Next, I have Apple and 0.3 shares in that, valued at £45 in my portfolio, up by 13%, which is a positive return of £5.28. Apple over the past month hasn't been doing too badly. We can see that it went all the way up to around 12th of October, and overall in the past month it is down by £1.49. They pay a very small dividend yield of 0.55%, and you can see the revenue is going up, income is also going up slightly. From the balance sheets look fine, and from a cash flow perspective, operating costs are huge, and that covers everything else, as well as Apple having enough cash anyway, as everyone knows, to cover quite a bit regardless. So next I have 1.16 shares in Amazon, valued at £119, up by 27% in my portfolio, and that is a nice return of £25. Over the past month, Amazon are down by 7.5%. They don't pay a dividend yield, but as you can see from the income statement, revenue is up, balance sheets look good, and from a cash flow perspective, a lot is being spent on investing, but it's Amazon at the end of the day and they are in a good position to grow in the future. So then I have 0.14 shares in Alphabet, which is Google. They are up 50% in my portfolio, up by £5.30, currently valued at £15.88. You can see over the last month, they are still up by 1.41%. No dividend yield, but as you can see from the income statement, revenue's gone up, balance sheets look great, and cash flow looks fine too. And you can see that their operating income is around £91 billion a year. Last I have AMD, only 0.03 shares in that, and that is worth £2.69, up by 34% in my portfolio, and that is also a 69 pence increase. Over the past month, just like Google, they are up by 1.49%. They don't pay a dividend yield, however, you can see income statement looks great. Balance sheet, you can see the amount of assets they've gained in the last year is absolutely crazy, completely exponential. From a cash flow perspective, you can see a lot of it is being spent on financing, which is fine as long as their operating income stays high. So next I'm going to show you my one pie that I have, and that is a copy of the almost daily dividend pie. This is not doing too well over the past month. It is down by 6.17%. and that is a loss overall of £23.20. I did mention before that I accidentally took out £25 into this, but for all intents and purposes I pretty much have £400. You can't put in £25 back as the minimum investment is £50. Very quickly go through some of the holdings. So there's 50 holdings that basically stagger around the year so that you get dividends very frequently. It's usually a few days of every week, meaning it's almost daily dividends. Some of the companies include Apple, which are up by 13%. Some companies are down hugely, like you can see Realty Income is down by 25%, 3M is down by 30%, LTC Properties down by 23%, British American Tobacco down by 26%, and all these other companies that I'm going to quickly scroll through, but if you want to check this out, I'll leave a link in the description down below where you can actually check out this pie. So here is my stocks and shares ISA, and as you can see it is not doing well at all. Current portfolio value is 19,086 pence, and this is the most I've ever seen my trading 212 portfolio down by. That's negative 11.39%, a loss of £2,454. Now if we go into history, you can see my realized profit and loss. It is standing at a plus £1,110. This ISA is a new ISA that I started April of this year, so it's only 1 year of deposits, not even a complete year yet. So you can see I like to keep my ISA very simple. So I've got only 2 holdings, 716 shares in the Vanguard FTSE 250. Over the past month, down by nearly 9%, and as you can see, just this alone has yielded me a loss of 11.48%, or a loss of £2,453, which does sting a lot, but I like to think that whenever dividends come in, I can just reinvest them at a much better price. Because I have a 100% ISA utilization, I'm not going to anytime soon be putting new money in it, so it's only going to be from dividends that are going to be reinvested. So lastly, I have 24 shares in the S&P 500 by iShares. This was purchased from the dividends I got from the FTSE 250. As you can see, over the past month, down 5%. Not doing too badly in my opinion, and I think right now this S&P 500 is at such an attractive price that if I had more money to be throwing away, I would definitely put it into the S&P 500. But I also think the FTSE 250 is at a great price at 26.38. It hasn't been this price since around 2020 during the peak of the pandemic, so I do think that right now you're going to get a good price buying now, but even then the price of the FTSE 250 could still likely go down even more. Make sure to check out some of my other videos, and I will see you in the next video.